Gentlemen, today is November 5th, 2025. Here's your daily dose of irony. A new article on Goldwire. You can read this at goldwire.io. The debasement trade. Money printers now recommend gold. For years, Wall Street dismissed the idea that endless liquidity might actually debase the dollar. Now, the same institutions that survived and thrived on bailouts are quietly pitching clients the debasement trade. In a twist of financial irony, the arsonists are now selling fire insurance. For years, the official line was that inflation was transitory, a temporary side effect of pandemic stimulus and supply shocks. Now the same banks that parroted that script are pitching clients the debasement trade, or the flight into real assets. It is important to remember that most products on Wall Street are derivatives of credit, including the money itself, which, as J.P. Morgan, the prominent banker, quipped during a 1912 testimony before Congress, gold is money, everything else is credit. Turns out inflation wasn't transitory, it was a transfer from the public balance sheet to Wall Street's P&L. From bailouts to debasement, J.P. Morgan's research desk recently coined the term debasement trade in late 2024 to describe investors rotating out of fiat-linked assets and into hard assets or hard stores of value such as gold. The logic: chronic fiscal deficits, political dysfunction, and monetary expansion have eroded faith in paper money, just months after the same bank was assuring clients that inflation was transitory and rates had peaked. It's a persuasive argument, and one that might sound familiar to anyone who spent the last decade shouting about QE, ZERP, and bailouts. What's new is the messenger. The very institutions that engineered the era of cheap money are now warning clients about its consequences. It's a remarkable pivot. The same institutions that spent a decade flooding markets with liquidity now warn that liquidity itself is the problem, when the cure becomes the trade. Back in 2008, Wall Street was saved by the printing press. The Fed's emergency programs liquefied the banking system and reinflated asset prices, recapitalizing the same balance sheets that had imploded under their own leverage. Inflation, though delayed, was the lubricant that restored solvency. Now, with fiscal deficits ballooning and debt to GDP north of 120%, the medicine has become the malady. The dollar is strong in name but weak in faith. Investors are buying gold, and the rally looks less like speculation and more like insurance. And Wall Street, it's selling the cure to its own disease. Monetizing the meltdown. The debasement trade isn't contrition, it's capitalization. For the same banks that lobbied for bailouts and thrived on money printing, it's the latest way to profit from the predictable decay of the currency their own rescues set into motion. For years, they denied that credit expansion was inflationary. Ben Bernanke even insisted that the Federal Reserve wasn't printing money, hiding behind the technicality that creating electronic credit isn't the same as issuing paper cash. Now the public endures the slow bleed of higher prices. Wall Street has found a new way to monetize the damage. The same system that sold the bubble is now selling the hedge. The final irony: J.P. Morgan's analysts aren't wrong. Deficits matter, and fiat confidence is fraying. But it's hard not to marvel at the spectacle. The institutions that were once too big to fail, now promoting the trade that celebrates the failure of the money itself. The same players who inflated the system are now telling you to hedge against inflation. And in classic Wall Street fashion, they'll take a fee on both sides.